Trump's trade policies. Impact on retirement savings. The looming fear of financial ruin in retirement weighs heavily on most Americans, more so than death itself, according to a recent Allianz study, which found that 64% of people are more worried about going broke than dying. But how do presidential trade policies, such as those enacted under Donald Trump, actually affect the money you've saved for later in life? Finance experts suggest the impact is complex, a mix of potential setbacks and strategic opportunities. Uncertainty and market response tariffs introduce volatility. Melanie Musson, an expert at Quote.com, explains that tariffs trigger anxiety, which ripples through investments. Industries hit by these tariffs face rising consumer costs, reducing spending, or squeezed profits, cutting into business growth. However, Musson points out that tariffs can also benefit certain sectors. American manufacturing in specific industries positioned to gain from trade barriers might see better performance. The key is adapting your portfolio to capitalize on these shifts rather than being caught off guard. Long-term resilience. Marcus Sturtevant, SR, of the ABC Squared, stresses that successful investors focus on fundamentals: earnings, interest rates, and employment. For those with a long-term retirement outlook, the political rhetoric is just noise. A smart strategy might involve increasing cash holdings or shifting toward income-generating assets. Those already retired are typically less exposed to market swings and more protected with their existing asset allocation. Sturtevant notes a trend observed in 2025 where gold, international stocks, emerging markets, and alternative investments outperformed as investors sought diversification outside the U.S. If 2026 follows suit, chaotic first half giving way to clarity later, staying invested and taking income from cash positions while equities recover could be a winning approach. The psychology of investing. The most overlooked factor. The stock market does not care who sits in the White House. Historical data shows consistent returns of 7–9% regardless of administration. Including political beliefs in investment decisions will cost you money in the long run. Investors must separate personal convictions from financial realities. The market doesn't care about politics. It cares about growth, stability, and returns. Ultimately, navigating trade policies requires a disciplined, long-term strategy and a clear separation between market fundamentals and political anxieties.